Hello, we're coming to you again from E-mini Volume Profile Day Trading. That's eminiprofiledaytrading.wordpress.com, and I'm talking to you today on the weekend after the week of trading. It is now January 8th, 2011, and what I want to do today is follow up the last two videos that we just put out, which maybe some of you have seen on YouTube. This is our E-mini Pro Traders channel, and the last two videos were the Euro MT levels and other tools part 1 and Euro MT levels and other tools part 2. And those are the last posts in my blog here, so you have various opportunities to see them. So these are the two videos that we just put on there on the 5th. And as you go through those two videos, you'll see some points where I make reference to these key levels that we've been focusing on those two videos, how we're using these very accessible tools in the free software of NinjaTrader, and we've incorporated, along with the market profile levels, we've incorporated the use of Fibonacci, and we saw this perfect entry that we covered in great detail on that video that went right to the tick, to the point of control from the market profile previous day's action. And it was also a perfect confluence there, just a few ticks under the 78% retracement level. And then we even added our stochastic there, and this is a 15-minute chart, so you had plenty of time. Now, on those videos, you'll see I made reference several times to using our market delta tools that have been explained and demonstrated on many, many different videos earlier on our blog. And you can see those as we've talked about using our intraday setups and triggers. That's why whenever you watch a video on this blog, if you haven't watched the previous videos, then obviously you're not really prepared to fully understand whatever the latest video is. So that's why I always urge everyone, be sure you go back to the very first post and watch these videos in sequence, and then you'll have a really good basis for being able to trade these techniques that I'm demonstrating in the individual videos. So you could see many instances where we talked about delta divergence on the different time frames, going down 4 minute, 3 minute, even 1 minute, whatever. But now what I want to do today is we're going to demonstrate numerous examples, so you can see just by the sheer frequency of them how you definitely can go down on look at your delta, and when you get these key levels, which are very, very clear if you follow the logic of how we demonstrated on these last two videos, part 1 and part 2, when we find a level, we can use our delta to give us very, very clear a very, very clear indication of a very high probability time to enter with a very low risk. So that's what we're going to do right now. We're going to go into the consideration of how, when we get to one of these levels that we've identified on our other charts, using maybe the market profile levels or a level from earlier consolidation of today's trading, where we can go down to whatever, a 5-minute or any time frame you like, to pinpoint the exact moment of entry. We can get in a few ticks from any high or low. Now, here's an example. I've taken, I'm going to look at a series of charts in the last 6 months of trading of some examples of what we're talking about. So one of the key setups is when we see delta has been strong on a direction, and then it diminishes and you make a new high, let's say, if the market's been going up, or if the market is going down, vice versa, you look for a new low bar where the delta dries up. So here's an example of a market that was moving up, And what happens when it finally is going to run out of gas in terms of our, hindsight evaluation? What you'll see if you're watching it in real time is that there is a supply of resting limit orders just waiting at a certain level, and this is quite typical actually, maybe 10 ticks past the handle. So if the market's going up, you'll see this commonly between the, let's say, 10 and 15 level on the other side of the even, in this case, 2300. So the big even numbers that come every 100, when they get through by 10 or 15 ticks, that's often a turning place. A lot of people just set their sell orders there to wait for the people who are buying at the end of a rally. So what we see is the delta values tend to bunch up. So you would say, oh, gee, there's 277 buyers there. Why did it turn? Well, because that was the end of the buyers and there were more people selling. That's why. So what you'll see is without any remaining buyers available to follow through at higher prices, the delta reverses by the time of the close of the bar. So you may have a spike in volume where all the orders are accumulating in that place, but the volume isn't including enough buyers. So the spike in volume adds that enhanced confirmation, and the lower delta. So what you had down here is 359 more buyers and sellers, 203 more buyers and sellers, and then you get up here, you have actually 105 more sellers and only 50 more buyers here, even though the volume was so high. That means that all this new volume were new sellers. So when you have that combination of a market going up on strong delta and then the delta reverses anything, let's say, 30-40% of whatever the strong delta peak was, that means there's a reversal. And if you have the volume spike with that, that's an additional strength of confirmation. So the bar makes a new high and the delta dries up, and if you throw in the bonus of the volume spike, that's a really solid trade. Now, let's look at a number of examples that give us these examples of these delta reversals, and you'll start to see how frequent these events occur, and they can be very useful for you to time your entries when at these prices that you have the levels on, as we've seen in those recent videos. Okay, here's an example on an 8-minute bar. In this case, it's a buying opportunity as huge volume going down of 1,800 more sellers, and then it was diminishing a little bit. You had 1,300 more sellers. That's still quite a lot. But then you have a bar making a new low with a long tail, almost a hammer, and 273 more buyers and sellers. That's a very dramatic reversal, and you can see it graphically very easily there. Now this is another kind of a volume pattern in this situation. If a market's going down strong and the higher volume there, then you find that the volume gets lower at a low. What that means is there are fewer people willing to press the downtrend, and then even though there were fewer people, the delta reversed to 273 more buyers. So that means there's an extremely high percentage of whatever volume was there has now shifted to the buy side. So that's a very solid floor under the market. The next bar came down, and unless you had an increase in volume again, there weren't going to be enough sellers to break the will of those buyers who just jumped in there. So this was a great opportunity. You could have bought even at the low tick or within a tick or two of the low there. And we're down here around 35.90, and it got up to 36.20. So that's 30 ticks on the euro. That's over $400 of profit potential from 10:40 to 11:30. So half hour, 45 minutes of trading, you could have gotten yourself 30 ticks or more. So that's another example at the buy side. And you notice these bars that we're using here are another way to picture the individual price points where the volume is the highest. So you can see here the volume was lower at the bottom and stronger in the middle. So this forms a little sort of intraday let's say, a 16-minute point of control here. That's what this black line is. So you could have bought the retest here at that high volume node of this period of trading, and you got in very, very close to the low there. So that's another little technique we can use with these delta bars. Let's look at more examples. Now here's an example of another turn at a high, and this is something you'll see which is a really fantastic trading opportunity. If you have a big spike in volume and a big spike in delta like this, and it's like it's breaking out of some little range, and then the volume really rushes in, and then the following bar, it very quickly, strikingly reverses. And as you can see here, you went from about 700 more buyers, and then all of a sudden you're down around almost even. You're at 90 buyers, but it's on lower volume. So the sellers obviously just completely took over on this bar, and it's a shooting star. And you went back up just 2 ticks from the high there. So it was a great, and you can see there it was right on the high volume node of this individual 8-minute bar there. So you could have gotten in very easily 2 ticks from the high of that bar just by putting your order in at that higher volume level. And a very, very clear signal. This is what I call pattern number 1, where a bar makes a new high and delta diverges dramatically from the previous bar. In this case, you had it augmented for even higher recognizable and higher probability by the shooting star candlestick, and the fact that the volume diminished on the high there, indicating there was no will for anybody to go pushing this market higher after this move. And this was a case where you basically caught the high on that very strong pattern. Let's look at some more. Now here's an example of what I referred to on many of the earlier videos as pattern number 2. Pattern number 2 is where you get a high, and then within, let's say, 2 to 5 bars after that, there's a retest of that high, but the retest is on a big reversal of delta. So you had 700 people pushing it at the high here, and then you had only one inside bar. They tried to break higher just 2 bars later, and the volume was less than a third. So yeah, it was probably more like 28% or something of what the volume was on this bar. And then plus, you had a big stem, so a big fall off on that candle by the close, and you had plenty of opportunity to sell there because you'd want to put your order in somewhere in here, and actually you would have had to respond pretty quickly, but that's still very close, because if you're getting in on the close there, you're only 2 ticks or 3 ticks from this resistance here, so you could have used a 6-tick stop very comfortably. And we're just actually, all these examples were appearing on the 17th and the 18th. Let's look at some more. So here's an example from a few days later on the 24th, and here's one where we're seeing a slam dunk, really, really obvious reversal, where all of a sudden the buyers and sellers really got evened out with a lot of resting limit orders there, and a very striking peak in the buying volume here at 1100 or so, and by the time it's up to the high, it's still pretty strong. There's almost 800, but then on the high bar, not only a reversal of the number of buyers, but a huge reversal of 1,500 buyers and sellers, going from 755 positive to 800 negative, and a strong reversal bar closing close to the low of the bar by the end, and you had an opportunity to get in maybe 5-6 ticks from the high there. You had a long time to pull it off, but such a strong indication at a high is a very high probability trade. Now I'm going to stop the video here, and we're going to continue with more examples. So check out part 2.